The first 25% is a tax-free lump sum, and for reminder, you can buy an annuity which guarantee of fixed income for the rest of your life. It may be possible you can access your retirement savings early if it's specified in your pension policy paperwork. Usually, those forms are not authorized by Financial Conduct Authority. So far in pension series, we covered pension basics, employee contribution, self-employed contribution, contribution through company, benefits of pension, 6 critical pension mistakes, buying a commercial property, using your pension fund, and pension withdrawal rules. In this video, I will explain one thing, which is pension withdrawal rules. So let's get started without a further ado. Here in the UK, you can withdraw from your pension pot when you reach a retirement age, which is 55 years, and from 2028 it increases to 57 years. The first 25% is a tax-free lump sum, and for reminder, you can buy an annuity which guarantee of fixed income for the rest of your life or for fixed number of years depending on your circumstances and terms and conditions with your pension provider. However, you can only access to your pension pot early if you meet certain conditions, like for example, you have ill health conditions or some other severe medical conditions. It may be possible you can access your retirement savings early if it's specified in your pension policy paperwork outlining the age which you began to access your pension pot. However, this must be granted before 6 April 2006 to be valid, and it is applicable only to certain professions where early retirement is typical, such as professional sports. If none of these circumstances apply, then it might be a case HMRC view early release of your pension funds as an unauthorized payment, and they might charge you a tax charge of up to 55%. Because of this high tax charge, it is very unlikely that a reportable pension provider will help you to access and release your pension funds early. It might be a case you have to request help from a third party. They could charge you 30% to do so, which means you could only left 15% of your overall pension funds, and usually those forms are not authorized by Financial Conduct Authority, which means you have no protection if anything goes wrong unless you meet some of the criteria I have mentioned or have been explicitly asked by your pension provider that you qualify for early pension access. You should not trust any of the third party to act on your behalf to access your pension before your retirement age. Now, let's say you are 58 years old and you want to access your pension pot. Now, what happens to your pension pot when you take money out? Whenever you access your pension pot, your pension provider will ask you, have you ever access your pension before? This is so they should know how much tax-free cash you have already taken out. Let's say you have 3 pension pots, £300,000, £500,000, £600,000, and 25% of which will be £350,000, which is a tax-free amount for you. Now, if we generally look at it, we can say that tax-free amount is £350,000. However, this is not a case. Here where lump sum allowance comes in. Lump sum allowance is a maximum amount that you can take from your pension pot without being tax charged on it. For 2023-24 tax turn, lump sum allowance is £268,275. So bear in mind your tax-free amount will be lower of lump sum allowance and your pension withdrawal amount. In this case, case, it will be 268,275, which is less than pension withdrawal amount of £350,000. Now, you want to withdraw £100,000 from your pension pot. So bear in mind, this withdrawal will reduce your lump sum allowance to 168,000, which means the maximum amount after this withdrawal you will get is £168,000, which is a tax-free amount for you, and after that tax will apply. Since we discussed lump sum allowance, let's quickly go through three types of withdrawals that don't count toward lump sum allowance. That means your allowance won't reduce if you are taking your whole defined benefit pension in one go. Pension is worth less than £30,000, known as a trivial commutation lump sum. You are taking a pension that's worth £10,000 or less in one go, called small pot lump sum. Your pension scheme is closing and your full lump sum is less than £18,000, known as winding up lump sum. So overall, in pension withdrawing video, we cover high tax charge on early pension withdrawings. What happens when you take money out, lump sum allowance, and types of withdrawals that don't count toward lump sum allowance. In next video, I will explain how pension will impact your IHT charge. So stay tuned. As always, hand ahead. Salute until the next video.